Hey everyone, welcome back to Corporate Decoder, a place where we decode the labyrinthine world of corporate filings to bring you the juicy bits. Today we're diving deep into the latest report from Nuveen Municipal Credit Opportunities Fund, and let me tell you, it is a doozy. We're talking billions in investments, complex financial instruments, and a whole lot of municipal bonds. And before we dive in, make sure you are subscribed and hit that notification bell. And definitely join our Discord server linked in the description below. It's where the real decoding happens. So what's the big picture here with Nuveen Municipal Credit Opportunities Fund? Well, it looks like a pretty massive operation. As of the 31st of October 2025, we're seeing over $4.6 billion in long-term investments alone. That's a mind-boggling number. Think of all those individual bonds. All those municipalities across the country relying on this fund for financing. The vast majority, nearly 98% of their total investments are in municipal bonds. These are essentially loans to state and local governments or their agencies. When you invest in these, you are helping to fund things like roads, schools, and water systems typically, and the income you get from them is usually free from federal taxes. That's a big deal for a lot of investors. Let's start with Alabama. It's a pretty significant chunk of their portfolio, almost 3.1% of their net assets, which translates to over $84 million. They've got a pretty diverse range of Alabama investments here, from Housing Finance Authority bonds to Energy Gas District revenue bonds. Some of these have some pretty long maturities, like some going out to 2055. California represents a huge slice of the pie, over 12% of their net assets, more than $351 million. This is where you see some really massive investments like over $53 million in California statewide Communities Development Authority revenue bonds, maturity dates stretching out as far as 2056. It really highlights the long-term nature of municipal lending and how vital it is for funding major infrastructure. Now, this is where it gets really interesting, and this is what we're here for at Corporate Decoder. They're playing with some complicated financial toys, and we need to see how that impacts the bottom line. Let's talk about what they call floating rate obligations and MFP shares, net and VRDP shares. Net. First up, floating rate obligations. This shows a negative impact of over $181 million. This essentially means these investments lost value. Think of it like owning a home where the value suddenly drops. Then we have MFP shares net with a negative impact of over $516 million. This is where the story gets particularly juicy. These are essentially preferred shares, and the fact that they're net negative means the fund either bought them back at a loss or their value significantly decreased. A drop of over $516 million is huge. It is like losing more than half of your initial investment in this category. And then there are the VRDP shares, net a staggering negative impact of over $1.2 billion. This is the biggest hit they took for context. That is more than the fund's entire net assets applicable to common shares, which is about $2.7 billion. This means that these investments lost more than 40% of their value in this reporting period. That is absolutely massive and certainly raises questions about the strategy behind these investments. The total annual expenses for NMCO, for example, are 4.50%. This means for every $1,000 you invest, you are paying $45 in fees and expenses. That's a significant chunk and something investors should definitely keep an eye on, especially considering the negative performance we just saw from some of their leverage instruments. Looking at the bottom line, the net assets applicable to common shares are about $2.7 billion. That sounds like a lot, but given the massive losses in those preferred share instruments, it suggests a significant reduction from whatever they started with. Now, every good financial review needs to look at what the auditors are saying. PricewaterhouseCoopers, or PwC as they're known, gave their stamp of approval. They say the financial statements present fairly, which basically means everything looks pretty standard and accurate according to accounting rules. But here is the kicker. They also mentioned that unqualified opinions were given on the financial statements as of and for the year ended, the 31st of October 2024. This means last year's numbers were solid, but this year's numbers, especially with those preferred share losses, tell a very different and much more concerning story. They are stating that the financial position is fairly presented as of the 31st of October 2025, but the large negative returns in those preferred shares suggest issues that a standard audit might not deeply uncover. Some pretty concerning notes here. We see that the fund is investing in things like defaulted security and below inverse floating rate securities risk. These sound like high risk, high reward plays, and the numbers in the financial tables certainly reflect that risk. The portfolio composition shows a massive concentration in municipal bonds. That is a given. But look at the credit quality. 19.1% is rated NRR, meaning not rated by these national agencies. That's a huge chunk of unrated debt. Typically, unrated debt means higher risk for higher potential rewards. And speaking of risks, they list out a lot of them. We're talking about anything from credit risk and duration risk to even more niche ones like tobacco settlement bond risk. It's a good reminder that investing in municipal debt, especially the lower rated kind, is not for the faint of heart. Alright, let's summarize Nuveen Municipal Credit Opportunities Fund, or NMCO as it is known, is a massive player in the municipal bond market. They're dealing with billions, and while municipal bonds are generally considered safer, this report highlights some serious red flags. The huge losses in their preferred share investments, particularly the VRDP shares, are a major concern. It is like having a big chunk of your house suddenly lose over half its value. The company is trying to reassure us with its audit findings, but those numbers speak for themselves. The reliance on unrated securities is also a point to consider for risk-averse investors. This fund is definitely not for someone looking for a guaranteed safe bet. So, what's the verdict? Nuveen Municipal Credit Opportunities Fund is in a challenging spot. They've got significant exposure to high yield and unrated securities, and their leverage strategies, particularly with those preferred shares, seem to have backfired significantly this past year. While they're still a giant in the field, investors need to be aware of these risks. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below if this deep dive was valuable. Hitting that like button really helps, and subscribe for more corporate document breakdowns. And don't forget to check out our Discord in the description, it's where the real discussion happens. Thanks for watching, and we'll see you next time on Corporate Decoder. Hey everyone, welcome back to Corporate Decoder, the place where we decode the labyrinthine world of corporate filings to bring you the juicy bits. Today we're diving deep into the latest report from Nuveen Municipal Credit Opportunities Fund, and let me tell you, it is a substantial look at their financial health. Before we dive in, make sure you subscribed and hit that notification bell, and hey, join our Discord community linked in the description below. It is where the really good decoding happens. Alright, so what story are these numbers telling us about Nuveen Municipal Credit Opportunities Fund, or NMCO for short? This report is from the 31st of October 2025, and it paints a picture of a fund with massive investments, primarily in municipal bonds. We are talking about over $1 billion of corporate bonds and over $873 million in municipal B. ONS alone, this immediately tells us they are heavily concentrated in this area, which is their stated goal. But it also means they are sensitive to the ups and downs of that specific market. The big headline here is that almost all of their long-term investments, that is over 166% of their net assets, are in municipal bonds. This is their core business, and when we look at the breakdown of the portfolio by credit quality, we see a heavy concentration in unrated securities, a whopping 64%. That is a significant chunk, a massive gamble from a risk perspective. Imagine that almost 2/3 of their investments are in bonds that the big rating agencies are essentially saying we don't have enough information or confidence to assign a rating. To this is akin to gambling on companies without a credit score, a huge roll of the dice. California alone makes up a whopping 12.7% of their assets, over $351 million invested there. That's a lot of exposure to one state, and potentially to one set of economic and political risks. If California stumbles, NMCO will feel it. Now let's talk leverage. This is where things get really interesting. They're using effective leverage of 42.24% and regulatory leverage of 40.14%. What does that mean in plain English? It means they're borrowing a significant amount of money to invest more than they actually have. This amplifies both potential gains and potential losses. Think of it like using a credit card to buy more stocks than you could afford. Outright, it is a risky strategy that can make good times even better, but bad times absolutely devastating, especially when you consider the massive losses we're about to see. And speaking of losses, hold on to your hats, because their MFP shares net show a negative value of over 67% of their net assets. This is a huge red flag, a loss of over $670 million. That means this specific investment category has drastically underperformed, bleeding money and dragging down the overall fund performance. It is like having a credit card debt that is growing much faster than your ability to pay it off, leaving you in a deep hole. And then there are the VRDP shares at a staggering negative 44.7%. This is another massive hit, representing over $1.2 billion in losses. Yes, you heard that right, over $1.2 billion in the red. This isn't just a small dip, this is a catastrophic drop, indicating a severe problem with this particular investment straight. Guy, when we look at the net realized and unrealized gain loss, it shows a massive unrealized loss of nearly $42 million for NMCO. This is a direct consequence of those troubling preferred share investments. We are seeing the impact directly on the fund's value. Now, for the bottom line, the net assets applicable to common shares are around $602 million. But remember that huge negative number from the preferred shares, over $1.2 billion lost in VRDP shares. Alone, this means those preferred share losses have eaten into the net assets quite significantly. So what about the auditors? PwC says the financial statements present fairly, but they also hedged their bets by mentioning that the financial statements for the 31st of October 2024 got an unqualified opinion. That is a positive sign from last year. But this year's numbers, especially the preferred share performance, tell a much more complicated story. The auditors are confirming the reported numbers. But those numbers themselves signal a major issue in the fund's strategy. The portfolio composition is heavily skewed toward unrated municipal bonds, over 64%. This is a huge gamble akin to lending money to someone with no credit history. You might get a great return, but the risk of losing it all is substantial. Adding to the concern is the sheer volume of these investments. Over $600 million worth the risks listed are extensive, covering everything from credit and duration risk to more obscure ones, like tobacco settlement bond risk. It is clear this fund is playing in a higher risk arena. So to wrap it all up, Nuveen Municipal Credit Opportunities Fund, or NMCO as it is called, is in a tricky spot. They are deep. They invested in unrated and below investment grade municipal debt, and those preferred share investments have taken a massive hit. That nearly $1.2 billion loss on VRDP shares is a giant alarm bell ringing loud and clear, while the auditors say the financials present fairly. The numbers themselves tell a story of high risk yielding potential. Lee. Catastrophic losses for investors. This fund is not for the faint of heart. It is for those willing to bet big on the municipal market, hoping for high returns while accepting the very real possibility of significant losses. What is your take on these numbers? And what do they signal for the company's future? Drop your thoughts in the comments below. If this deep dive was valuable, hitting that like button really helps. And subscribe for more corporate document breakdowns, and don't forget to check out our Discord in the description. It is where the real discussion happens. Thanks for watching. See you next time on Corporate Decoder.